create and analyze risk-reward option graphs. Before you place an options trade, you should fully understand the risks and rewards of the position. In this video, we're going to talk about creating and analyzing risk-reward option graphs in TradeStation's OptionStation Pro. This powerful tool helps traders evaluate different option strategies' potential risks and rewards before executing trades. To create an option graph in OptionStation Pro, you must first select the option you want to analyze from the Options tab. Before choosing, set the Click to Analyze Trade. This will automatically load the selected option into the Analysis tab and create a risk-reward option graph. Here we've added the symbol eBay to view its options chain. Let's change the spread selector to vertical and create an out-of-the-money bull put spread. The spread will appear on the Analysis tab under Positions and Simulations, and the resulting option graph will show the potential profit or loss that the position could incur from the option trade. This graph can be used to assess the risk and reward of different option strategies and make more informed trading decisions. You may use the checkboxes at the bottom left to select real or simulated positions and combine their profiles in the position graph. The x-axis of the graph shows the underlying asset's price, while the y-axis shows the profit or loss. The lines on the graph display the potential profit or loss the option's position could generate at various times during the option's life based on the underlying price. The yellow line represents the value of the option's position right now, and the blue line is the value at expiration. The green and the fuchsia lines can be added using the drop-down at the top left and represent 1/3 and 2/3 of the time until expiration. The specific dates on these lines can be seen on the legend at the top right of the graph. You can adjust these dates by clicking Settings, Graph, and using the Date slider. For example, if you know there is an important company event, such as an earnings release, you could adjust the slider to that date. You could see the theoretical profit or loss of the option strategy on that date to better evaluate your risk-to-reward ratio. The white dotted horizontal line on the option graph shows the break-even point, the price at which the option trade will neither profit nor have a loss. You can use this information to evaluate different option strategies and determine your option trade's optimal entry and exit prices. Below the graph is the Price Slices area. Adding a price slice lets you see how the options position would fare while the underlying security is at various price levels. For preset and dynamic slices, under the pinned column, we will select -5%, last, and +5%. You will notice that 3 vertical lines appear on the graph. One is the current price of the underlying, one is 5% above the stock's last price, and the other is 5% below. If we move our cursor to the lines, we can see the values of the options position based on how much time is left until expiration. We also see these values under the theoretical PL column for each price slice and what the Greeks would look like when the underlying security is at that price level. Note that you can click the plot dropdown to switch the values to a different plotted date or holding period. Click and drag the vertical lines to other prices or type in specific prices if needed. For example, if you are targeting a resistance level on the underlying stock while using a bullish strategy, you can enter that price and estimate potential profit for the option trade. You can also use the graph to assess the impact of different market scenarios on the options trade. For example, you can see how the options value changes if the underlying asset's price increases or decreases, or if the volatility changes. Below the graph, in the Positions and Simulations panel, you can adjust the volatility to see its effect on the option strategy. Let's return to our eBay example. Suppose we assume there is likely to be a 15% increase in volatility heading into the week of the earnings announcement. We can add the 15% volatility adjustment and change the date of the price slice to a week before expiration. The graph will show how those changes affect the option strategy's pricing. The gray shaded area behind the graph is the maximum expected price movement of the underlying security based on one standard deviation up to the option's expiration. Use the box at the top right of the chart to adjust standard deviations. You can identify potential risks and develop strategies to mitigate them by analyzing different scenarios. This can help you make more informed trading decisions and reduce the likelihood of significant losses. For example, you can see if the reward-to-risk ratio is acceptable from the graph before you place a trade. You can also determine whether a certain profit level is possible by placing your support and resistance levels on the graph as price slices, or that the intended target is within 2 standard deviations. If our intended target lies outside of 2 standard deviations, we can ascertain that it is unlikely that we will reach the target and may need to adjust the target to a more realistic price. In conclusion, creating and analyzing risk-reward option graphs in OptionStation Pro is a powerful tool to help traders evaluate different option strategies and make more informed trading decisions. By using option graphs for risk management, traders can identify potential risks and develop mitigation strategies. So get ready to explore and discover how OptionStation Pro can help you improve your trading performance. We hope you enjoyed this video. Thank you for watching and happy trading!